Thanks for tuning into this broadcast, and we're calling it a Diwali Dhamaka so early because the PM did mention that it's Diwali gift to the country, the GST rationalization. And what we've tried to do over the next 25 minutes is talk to two very eminent voices on what is their view on the impact that the GST changes can make. Now, before we get in our guests, let me try and tell you what brokerages are saying about this. So, multiple brokerages have come out with their view on what this could mean for the economy and the markets, right? So Citi first up, right? And when they are talking about how the annual fiscal cost about 0.25 or 0.3% of GDP, the total household-oriented policy stimulus in FY26 could be about 0.7, 0.8% of the GDP. It is all very constructive. Antique comes out and says that the GST rate rationalization may lead to about 5 to 6% hit on GST collections, 1.2 to 1.5 lakh crore or 0.3 to 0.4% of GDP getting impacted annually, and may partly be offset by a boost in consumption. MK says that it could cost the exchequer over 1.2 lakh crores on an annualized basis or over 0.4% of GDP, but naturally, so they also believe that there is an uptick in consumption ahead. Morgan Stanley views about 50 to 60 basis points impact on overall tax collections on an annualized basis. The loss in GST revenues could put upward pressure on the fiscal balance, but they believe that as growth picks up, the net effect will potentially be limited and the impact on central government deficit could be less than 0.1% of GDP. They expect the net effect on growth for indirect tax cuts to be positive. Lastly, the UBS view is that the revenue loss of GST rationalization could be the tune of 1.1 lakh crore or 0.3% of the GDP annually. Again, because everybody's in that ballpark range of 0.3, 0.4%, but they believe that GST cut can have a much larger multiplier impact than income or corporate tax cuts. And viewers, we've seen almost every single person on the buy side or the sell side talk about this being the big antidote that maybe the country and the markets needed when we're in the midst of the tariff issues currently. Imagine what will happen if and when the tariff issues get resolved. Let's focus on what this means for the economy and the markets and start off the conversation with one of my favorite voices, Mr. Nilesh Shah, MD of Kotak Mahindra AMC. Nilesh bhai, so good having you on such an important subject. Thank you for taking the time out and being with us, and I hope all is well.
So far, so good, though it is subject to Mr. Trump.
Yeah, well put. But Nilesh bhai, tell us, so one is the tariff uncertainty, we'll get to that. But if I look at this GST piece in isolation, how do you think of the pulls and the pressures because of the loss of revenue, but the boost in consumption that this could presumably bring? What impact, according to you, does this have?
So GST rationalization can serve multiple purposes. It's like one stone and multiple hits. The first will be to reduce the complexities around GST. We all have known that one or two rates compared to multiple rates which we have will be more beneficial to us. The second will be to stimulate domestic economy by supporting consumption. By and large, we have been more supply side focused. Now, GST rationalization could be demand side focused. Third, the stimulation will also help us negate adverse effect of US tariffs. So timing wise, it is coming at appropriate level. And fourth, and the final thing will be that as GST rationalization stimulates domestic consumption, it also supports private investment revival, and hence this becomes a longer term cycle rather than just one trick pony. So GST rationalization should be aiming to achieve multiple objectives with one stone.
Could you explain the last point, private capex or private investment cycle? Why do you say that?
So essentially, Neeraj, if we see private investment has remained subdued, all the catalysts for private investments are in place: ease of doing business, improving availability of credit, plenty with banking system full of liquidity, equity markets at all-time high level with enough capital available in IPO and OFS market, capacity utilization at 75% plus level, the leveraging in this picture is probably that spurt in demand, which can result into more capex. I'm sure there may be some other factor also, but spur in demand could induce private investment revival and make this cycle play over multiple years.
Yep. Okay. Neelkanth Mishra, our second guest on the show, also joining in. And Neelkanth, so good having you. We are trying to figure out what could this mean from an investment and from a markets perspective, but can't not ask you about first, what is the economic impact of something like this? Do you believe that there is a large multiplier in the offing because of the GST rates rationalization?
Yeah, thank you for having me on the show, and apologies for joining a few minutes late. You see, this acts like a stimulus, and in fact, it may sound oxymoronish, but this is a stimulus without any meaningful fiscal cost. And let me explain to you what I mean by that. So, in the worst case, in case if all items from 28 were to go to 18, all items from 12 was to go to 5. The total revenue loss for center and states put together would be about 1.7 trillion rupees. Given that some items are going to go from 12 to 18, some are going to go from 28 to 40, the number should be lower than that. This will also aid formalization. This will also help with volume growth in segments like autos. So the net impact should be meaningfully lower than that 1.7 trillion. But that's the worst case that I would think of. Now, in general, such a cut would mean that you now see the government borrowing more. And what we are saying is that that need may not arise because of something called the compensation cess. So in fact, the end of the compensation cess, so the constitutional provision for the compensation cess was that the state governments needed a 14% revenue, a CAGR, and it was guaranteed to them in the first 5 years of GST. And what that meant was that cess on coal, cess on tobacco, cess on large cars, sugary drinks, these were added, and that pool was used to finance and offset the revenue loss when the revenues for states fell short of that 14% CAGR. Now, what had happened in 22 and 23 is that the need for compensation was much higher than what was being collected. So the center had borrowed from the future. So effectively, the states were spending a lot more than what was being earned in GST that year. In the last 2 years, 25 and to some extent this year, the GST compensation cess collection has been used to repay that debt. So in a way, it was not being used for this year's fiscal spending. So our point is that this collection, as it gets subsumed into GST, will add to revenues, and therefore there is no need for the borrowing to go up. So this is the in a way the best of both worlds. We see a much more simplified GST. We also see a demand catalyst for large categories like autos, and we see that happening without a substantial impact on fiscal cost of borrowing. Bond yields have gone up. I think mistaken understanding that this will result in a lot of revenue loss, but I think that that will correct. So this is I think very positive, and it also shows good intent that the government has restarted the reform process.
Nilesh Shah was of the opinion that it also in some sense would spur private investment, which has been kind of amiss for a really long time. You reckon that can happen meaningfully? Can it happen immediately? Does it happen with of a lag, or is it in the remains to be seen camp?
So my view, and Neeraj, we have discussed this several times on your show, is that the critical aspect of the investment cycle is real estate. So, in fact, it is when the real estate cycle really starts to take off, is when the demand for manufactured goods starts to go up, And the last slowdown that we saw was to a large extent driven by the down cycle in real estate. Now, in the last 9 to 12 months, we've seen a bit of a slowdown in real estate sales. They've started to pick up again. So the cut in rates should definitely help. What I think this will do is give the necessary impetus. See, what happens in credit is that it has very strong pro-cyclical proclivities. So basically, when credit growth is strong, demand is strong because people are borrowing from the future to spend today, either in investment or in consumption, and that becomes income for someone. That income then becomes more credit worthy, and so there is a virtuous cycle. But when it reverses, it becomes a vicious cycle, and which is what we are seeing right now. When you are easing monetary conditions by the quantum that we have seen over the past 6 months, uh, the problem is that it does not bring back credit risk appetite. So as the economy has been decelerating, there are companies which are uncertain about the future and therefore do not want to borrow. Some of the banks which took on some of the risk are also early on and have seen a rise in NPAs are now pulling back. Some of the NBFCs in June quarter results talked about strong weakness, and therefore strong weakness is an oxymoron. Basically, the weakness was palpable and very broad-based, and therefore it takes a stimulus like this to actually turn what is a vicious cycle. It's like I don't know if you had experience of pushing a car. It's always the first push which is the hardest. And especially if the car is rolling backward, it becomes even more challenging. But once the car starts to roll, it is much easier to build momentum. And what GST and these moves will do and is doing is that it has stalled the market for some of the high value goods. So like the car market seems to be almost frozen. I can see when I do my grocery shopping that some of the packaged food items where the rates are going to change are showing as out of stock. So there is a destock. So the economy actually slows in the anticipation of these cuts. But then the restock happens. And that's when what is actually a vicious cycle starts to become a more upward focused cycle. So I do think that this will help. If this had not happened, my expectation was that November, December is the time frame when credit growth, because some of the larger banks starting to push credit on the unsecured side would boost credit growth. This may be increasing the probability and confidence in that.
Okay, but I like the oxymoron nevertheless, strong weakness, and maybe we can actually get out of that in a meaningful way. Nilesh bhai, now that I have you back, just trying to understand when people are thinking of, the markets and the tariff issues hit the markets hard. I mean, almost all sell-side notes that have come over the last 5 days are talking about how even the multiples may contract. The question is the GST rationalization a strong antidote to the tariff issues on flows, etc., or is it one of the small measures and more needs to be done? How do you see that?
So I will say GST rationalization is a step in the right direction. But in order to come out of the adverse impact of US tariff, at least at this point of time, market is discounting that it is short-term in nature, will require multiple other steps. One thing is to become truly Atmanirbhar in research and development in new age technology. There are few things which are easily doable, like data localization, but there are few other things which will take 5-year or 10-year roadmap. But we must begin a journey now so that 5 years, 10 years down the line, we could be Atmanirbhar in technology, in innovation. The second thing which will be required will be also improving ease of doing business. Today, many of the private sector investment is constrained, restricted by ease of doing business. The next generation is not really interested in dealing with Inspector Raj as probably their parental generation has dealt with. So again, we have to improve ease of doing business so that our entrepreneurs can take on the world rather than wasting their time with the inspectors. So GST rationalization is one step, but there will be multiple other things to require to ensure that we come out of this hurdle with flying color.
The markets would be wanting to know whether this and more steps have to be taken in the future, but the immediacy, tariffs have come in. Now, once the GST reforms get rolled out, let's say on the 5th of September or 22nd, as the case may be, and the festive season kicks in, buying kicks in, does it reinvigorate the market, which looks like a bit reinvigorated today, to be honest? But does this have the ammo to build the markets higher, or is it a market which remains a sell on rise, if you will? Neelkanth, the question is to you. Okay, but okay, Nilesh Bhai was answering. Okay, Nilesh Bhai, you can start off first and then we'll get to Neelkanth Mishra, please.
Sorry. At least at this point of time, Neeraj Bhai, I still believe markets will be volatile and choppy. It will react on events. At this point of time, market is discounting tariffs are short-term in nature. If there is escalation, for example, European nations joining in, or if it gets extended from current set of goods and basket to, let's say, including pharma or something else, then there will be certainly correction in the market. More importantly, the future trend of the market is more likely to be driven by earnings rather than valuation re-rating. So how does corporate earnings pick up after a slightly subdued first quarter? That also will determine what happens to the market. So at best, my guess, events will continue to shape the markets, and this will be a market which will be buy on correction rather than rise on sale for a long-term investor.
Neelkanth Mishra, your thoughts?
Yeah, so I mean, at least in the prognosis, or at least the expectation on what may happen to the market overall, not much to disagree with what Nilesh Bhai has said. When we are thinking about the domestic economy and the domestic markets, remember that the pace of earnings cuts has already started to slow. So, as we've often discussed, what matters is not that there are cuts, but the pace of cuts. So, every 3 months, given that FY27 EPS growth is expected to be again 14% or so, you are gaining 3.5% every 3 months. And if the pace of cuts is less than 3%, then your forward EPS is growing. And I think that's the right template and the right cycle to look at. So if the pace of earnings cuts slows to say 1% a quarter, your forward earnings start to grow, and that's, I think, quite supportive for the market. So as we start to see the catalysts, or at least the signs that the expected impact of GST rate cuts and the monetary easing is starting to show up in domestic momentum, I expect that time correction can speed up, meaning that P multiples remain range bound, but or rather P multiples sort of time correct, but the market stays range bound. What I'm most worried about is what happens globally. See, remember that now that after 4-5 months of drama, the tariffs at least are set. The sad reality is many countries who have apparently signed up, they still don't have any documents to show that. There are countries where apparently they've been told that 30% of your exports will be counted as transshipment, and therefore will be levied 40%. And it's completely random. So, but either way, in a month or two, maybe we start getting clarity on what the final rates are. And then in a few months, the US administration will figure out that the tariffs don't work, that the objective of levying these tariffs was to move manufacturing back to the US. There may be some song and dance about some announcements, but the reality of whether that's really happening or not, how much of that gets transmitted into consumer prices, our view is that quite a bit will be. So a large part of the additional fiscal revenue that the US federal government earns from tariffs will actually be paid by the US consumer. So when this starts to happen, what does the US administration do next? Because remember that, as we also discussed on your show, they have several large problems to solve. They have a very high debt to GDP. They have a very strong dollar, which they want to weaken. So will they start getting into dollar debasement? And in fact, you can even ask this question that if, say, the US has armed bases in Japan and South Korea and Saudi Arabia and Europe, is the is the holding of US treasuries by these countries a form of tribute. Remember that empires in ancient times were where military garrisons were positioned abroad, and those countries in return used to pay tribute. Maybe this is a tribute, and maybe the US tries to write that down. Imagine the kind of chaos that will create. So I expect that a global macro uncertainty is going to remain very elevated, and therefore, overall, we should still be quite cautious on the headline market levels.
Yeah, I think there was this article floating around as well, right? Extract wealth or win wars against an increasingly strong global south. Will the US feast on its own allies? And could that have an impact too? So very valid point. Final question to both of you, and Nilesh bhai, to you first. The other question that people would have, the domestics have stayed strong all through this while, and that's a great lever for comfort. But the dime on the global side is really on the wrong side right now, and we don't know when it will turn. Would that be a necessary condition, if not a sufficient one, for the markets to restart a rally? And can moves like the GST cut, the thawing of relationships with China, etc., help give that confidence, or does it require something else?
So essentially, for markets to go up, buying has to be aggressive, then the selling. Other things will fall in place. Now, for domestic buyers to become aggressive and give exit to FPIs will require earnings growth acceleration. Or as Neelkanth Bhai mentioned, some of the geopolitical headwinds turning down. On the other hand, if domestic situation worsens, then FPI selling may become aggressive. Neeraj Bhai, in the market, no one wants to give easy exit to anyone. There's always a tug of war between buyers and sellers. Buyers will take a view based on how things are happening. Same way the sellers will take the view. So a lot of will happen upon the events, but I still will say valuation re-rating looks unlikely at current level, and hence earnings growth will deliver return in the market. It's far more going to be bottom-up stock pickers market than top-down allocation.
Well put. And in which case, Neelkanth Mishra, can I request you to sign off the show by trying to tell us, when one looks at themes of what could do well, would it be domestic consumption, inward-facing themes that could do well, or have the global-facing themes been punished enough that the valuations provide comfort? How would you construct, let's say, an ideal portfolio?
Yeah, so I think that is the way I would look at things, because remember that a large part of the economic slowdown that we have seen is in India is because of the involuntary monetary tightening that was engineered last year. I don't think the intention was to slow down or have used such broad-based tools, but they were. And so if, say, credit growth slows from say 16.3% adjusted for that big merger in March 24 to 9.8% year on year in May 25, we are talking about a 6.5% point slowdown in credit growth in the banking system. And given that banking system credit is 56% of GDP, and that's more than a 3%. I mean, I'm also building in some share loss to the bond market, which tends to happen at early stages in monetary easing. So there's a more than 3% impact on GDP that happens because of that. So if that starts to reverse, the Indian economy is going to be doing far better than what we are seeing right now. So that would be the most important driver for me. In terms of, and so therefore rate sensitives, construction proxies, I think those would be NBFCs. Those would be my sectors where I would be overweight on. On global sort of growth headwinds, see, the uncertainty, as I was saying, is likely to persist. There is the only, I would say, silver lining is that if the market fears widespread currency debasement, that there will be competitive devaluation of currencies, something like what happened in the 1930s, then the nominal value of stocks will actually keep hitting new highs. So even as uncertainty creeps in, the fact that the businesses are now going to be valued in dollars, which are likely to be much cheaper, will mean that I think at least the nominal values will remain elevated. So that's the only silver lining. Otherwise, I think from a market fundamental perspective, remember that while the Fed is now widely expected to start the rate cuts in September in 2 weeks' time, the 10-year bond yields are not really moving down, and the fear that inflation could actually stay high and be supported by the pass-through of tariffs is actually going to be very important in the coming months. So yeah, so I would remain concerned about the global proxies.
Okay, concern on global proxies, domestics looking good, valuation multiple re-rating unlikely, and therefore a very bottom-up market. Companies and sectors which deliver growth, earnings growth, are likely to be the ones which will reward portfolios. Gentlemen, thank you so much for throwing so much of insight in such a short time, but really appreciate your views. Much appreciate this time. Thank you.
Thank you.
Thank you. And viewers, thanks for tuning into this very special episode.